Okay, so this is the first handout, and last class we talked about indexes and averages and how they are calculated differently, and how the Dow Jones Industrial Average is a poor representation of the wealth being created in the stock market. So we're going to calculate both by hand, so you could see exactly what the difference is between the two methods of calculating index or average. Now, a lot of times I'll get phone calls from personal financial advisors or people who want me to buy stock from them or mutual funds. And I always ask them this question. I said, I will purchase some products from you if you could tell me the difference between how the Dow Jones Industrial Average is calculated and how the S&P 500 index is calculated. What is the main difference and how are they calculated? If you can answer that question for me, then I feel comfortable investing in stock with you. And never once has anybody ever been able to answer that question, unless they were a former student. In that case, the deal doesn't count, because of course they would know how to do it. But you would think that someone who's an investment advisor would know this basic concept or calculation. So this is something that you could use as a litmus test for any future potential financial advisors, or if before you advise anybody, make sure that you have the answer to this question. Because it's fairly important, because clients will call you up and they'll say, oh, the Dow is down 200 points or 500 points, what should I do? The world is ending. And then you can explain to them, well, actually the way it's calculated in the stocks it represents, your portfolio is fine. That's just really limited to a couple companies in the Dow, which is making this big fuss, and people overreact to the Dow. So it's a good way of calming investors down to really help them understand the insignificance of the Dow 30, even though it's the most widely published. So here we have the basic formula. So if you see, here's a basic formula. The sum of the closing share price is divided by the Dow Jones Industrial Average divisor. So like I said in class, the divisor is something that they adjust from time to time to take into account any stocks that split, adding or subtracting new companies to the Dow, which happens occasionally, because they want to make sure everything between the close and the open, it remains equal. So if a company splits, the share price goes in half, the Dow Jones Industrial Average is going to go down. But it actually didn't go down because no stock value was lost. It was just a stock split. So that's why the divisor changes from period to period to keep the average steady. Okay, so it's a very simple calculation. Basically, this is a representation of only 5 of the 30 stocks. We're not going to do all. You simply take the sum in Excel. I can do that quite easily by using this sum command. And I'm just going to take the sum of these 5 stocks, so mini index, mini average rather, and then I'm going to divide by, I'm going to take this answer and I'm going to divide by the divisor, which is 0.145 in this case. So I get an average of 1,334.83. And that's as simple as it is to calculate a Dow average. So the second example over here, I want to give you a few minutes for you to calculate that and do it yourself. Okay, so you should have had enough time to complete the second example. So if, again, it's pretty simple. And it was created a long time ago, so they didn't really fully grasp what they were doing. And at the time, the 30 stocks did represent a huge percentage of the overall marketplace, so it did work for a period of time. However, in today's complex financial world, it's not a good solution, and it's not a very good measure of the overall marketplace. So we're able to get 2101. All right, so pretty simple, and that's how simply the Dow Jones Industrial Average and all the Dow components. There's many different averages the Dow publishes. Transportation, and this is just the industrials. So some of them have 10, 15, 20 stocks, all variables, but I think there's about 20 different Dow Jones averages that measure the stock market. And they all use this basic approach, which is most people consider not so great. So let's move on to the S&P 500 as an example. Now, the S&P 500 we look at the sum of the current market value, which means the current stock price and the current shares, and we divide that by the sum of the base market value. Now, the base market value is when it goes back to a particular date in the 40s when the stock first entered the S&P 500. Or if a stock is taken out or replaced, the new stock becomes in at whatever date they want to select for their base value. But basically, the base value is through time, it's adjusted for stock splits, and it gets pretty low as far as the price. Now, if you look at the S&P 500 through a long period of time, you could calculate other types of growth returns that we'll be doing more in Chapter 6. But right now, we're just trying to calculate the value of the S&P 500 index. So here in the base example that I'm going to explain to you, we have the base price of these 5 stocks. So this is the price that now represents after stock splits and things, basically stock splits. Since they became part of the S&P 500, this is the equivalent of a per share price from the beginning point they entered the S&P 500. And then we have the current stock price. So this is what the stock price is of right now, and the amount of outstanding shares. Now, the outstanding shares is critical for why this is a better calculation, because we are able to calculate a true wealth creation because we're reflecting the shares as well. So the base market value is simply taking the shares times the base price. So $1.25 times 1,000, I get 1,250. The current market is going to be a very similar. I'm going to take the same 1,000 shares, but I'm going to multiply it by the current price. And I get the current market value. So put those all in there. And the next thing I'm going to do is find the sum. So I'm going to get the sum of the base value, which again, I'm just using the sum formula, and I'm going to do the sum of the current market value. Now, so the first thing to do is divide the current market value. I'm going to do this in steps. I'm going to take the current market value and divide it by the base market value. Now, in the beginning, the S&P 500 index is very small, so they multiplied it by a factor of 10 to enlarge it. And it still stands today. So whatever this calculation is, we take the calculation and we simply multiply it by a factor of 10 to increase the size. So in this first example, the S&P 500 index here is really S&P 5 index, because I only have 5 stocks, is 308. So let me give you some examples before you do the next problem, the next practice problem. Let me just give you some examples of how this is more relatable. Okay, so if we go up here and we change, we'll go back to this example. If I change Johnson & Johnson to 55.4, increasing it by $5, it goes up to 198. I'm sorry, 1369 it goes up to. Now, if I change any of these by $5, it's going to be the same 1369 increase. Now, what if Johnson & Johnson has 10 billion shares outstanding, and this General Electric will just say has 100 shares outstanding? So if General Electric goes up $5, it has the same, you say about 30-point effect on raising the Dow. But $5 increase in a stock with only 100 shares only creates $500 of wealth. If we say Johnson & Johnson has $10 billion of shares outstanding and that goes up $5, we still get the 30-point increase on the Dow. However, we just created $50 billion worth of new wealth. And that's not really those same 30-point change in the Dow, $500 of new wealth versus $50 billion of new wealth. You see how it's not fairly represented in the change of the Dow price, because we're really just going by the per share value. We're not factoring the total outstanding shares. So here, if we have a situation where we have 2 stocks, one 25,000 outstanding shares, one 1,000 outstanding shares, we increase each by $1, so bring this up to 380, make it $2. Let's see. So right now we're at 308. So the current factor is 308. So if we increase the current price to 4.87, it really didn't change much. So it's 308.71. and it was 308.34. So very small change because it's only 1,000, oops. Sorry, that's the keyboard. Okay, it's only 1,000 outstanding shares. If we do the same thing for a stock that has 25,000 outstanding shares, we increase this to 48.41, we see it goes up to 317. So almost a 9-point change versus a fractional change. And that's because it's reflecting the amount of outstanding shares is very important to the actual wealth being created, and that wealth that is created in the marketplace is reflected proportionally in the change in the S&P 500 index. That's why it's a much better index for measuring the effects of the stock market. Okay, so I'm going to give you a few minutes to try the example problem right below. Okay, so that should have given you enough time to calculate this. So if we look at the answer key here, it's going to switch to the answer key. Now remember, each of the handouts comes with an answer key that you can go to from Blackboard to download the handout and then see the calculations behind the cells. And that way, if you're not sure of something in class, you can double check it online. And here, this small index has a amount of 114.59. Okay, so we're going to move on to another handout. Okay, so this handout is about placing orders. So we're working with the virtual stock market, and in the virtual stock market, you have the ability to place different types of orders. And I went through this the first week of class, but when you fill out an order, they'll have blue and I think orange type of highlighted buttons. It could be buy or sell. It could be market order, limit order, stop order. It could be buy long or sell short. These are all different options while trading stocks. So we're going to go through some of the mechanics and some examples or some of the more, some of the different types of orders you can place because they give you more control over your investments. So the most simplistic order is what we call the market order. So the market order is basically just like you going to a store. We'll use the example of chocolate milk. You go over, or maybe coffee. I think we're more coffee drinkers. You go over to the store over there and you say, I'd like a cup of coffee, and they say $2.50. And you pay it and you get your coffee. So simple as that. So as long as the store is open, as long as the market's open, your market order will execute. So if the idea is you placed a market order to buy 100 shares of Astro Technology, and the stock is currently trading at $41 per share, will your order execute? Yes, your order is going to execute. So write a yes there. And at what price? We say around 41 because in the marketplace, by the time you place your order and hit submit, it has to be queued up, and you may get a price slightly above or slightly below depending on where the stock has landed the same time the order executes. So there's the delay. By the time you fill it out and hit submit, it has to be routed, connected, settled. And in the time between you hit connect and in the time it settles, depending on how volatile the market is, you could get a slightly different and sometimes a greatly different price than you expected. For example, if you place a market order before the market actually opens, say there's like an IPO, right? And you want to buy this IPO, and you figured, I'll put an order in at 8:30, so I'll be one of the first people to buy it. Now, you're going to be lined up with everybody else who puts the order in early, and as the orders start to fill, they fill an order of placement, you may have expected to buy it at $40 a share, but actually traded at 51 because that was the best price at the time that your order came up. So you can see there's a real disadvantage for placing market orders because you're never 100% sure what you're going to get. All right. So if I say if the stock price moves up to $42.25 at the time your order is placed, what price will it execute and what price will you get? So will this order execute? This isn't a what-if situation. Yes. market orders always connect. So it'd be like you're going to get your coffee no matter what price they're charging because you need your morning coffee. So if it's $2.50, $2.25, $2.75, $3.50, you're getting it. Now the price, if it moves to $42.25, at the same time your order executes, you're going to get it at $42.25. So you looked at the market, it said 41, it moved to $42.25 at the time of execution, that's the price you're going to get. So if the stock price moves to $37.75 at the time your order meets the market, will it execute? Yes. So the simple answer, market orders always execute as long as the market's open. And here you're going to get something similar to $37.75 because that's the price it moved to at the time of connection. All right. So let's move to the next example. It's called a fill or kill limit order. Now, fill or kill means they're only going to ask once. So say you send a proxy. Basically, when you buy a stock, you're not buying it yourself. You're buying it through an agent, a stockbroker. Now, say the same thing for this coffee. You're going to sit in class and send another student over to buy the coffee for you, and you basically say, I want you to buy this coffee for me, but you're putting a limit on it. You say, don't spend more than $2 for the coffee. And they say, well, the student may say that's going over your agent. I don't understand. Can you clarify what you mean here? I said, this is what I mean. Listen to me carefully. If it's $1, you buy it. If it's $1.25, you buy it. If it's $1.50, you buy it. $1.75, you buy it. $1.99, you buy it. $2, you buy it. $2.01, you don't buy it. $2.02, you don't buy it. $2.25, you don't buy it. $2.50, you don't buy it. Are we clear? And they're like, geez, fine. All right, we're clear. So that's the same thing with the fill or kill, but they're only going to go over there and ask once and come back. So if it's $3 for coffee, they go over there and ask, and it says $3, they say, okay, forget it, and they come back and say it was $3, you say, okay, fine. So that's what the fill or kill limit order means. So you set a limit, how much you're willing to pay for something. And you will pay up to that limit or better, but you won't pay more. Okay. So the basic questions are going to be, does the order execute at what price? So the first what-if scenario is, if the stock price moves to $42.25, will this execute? No, because it's higher than your $41 limit. So you will not pay more than your limit. So this is what gives you some control. So you can put a control in to make sure you don't pay more than you really want to for a stock. Okay, so let's move to the next question. If the stock price drops to $34 3 days later, will this order execute? No, because fill or kill is one moment, right now. So if you asked for that coffee right now and sent that guy over to buy coffee for you, why would he buy it 3 days later for you? He can't even probably find you to deliver it to you. So it makes no sense. Same thing with the marketplace. Now, the price drops 3 hours later, will it execute? No, same thing. 3 days, 3 hours. You go over, as soon as they get there, they ask once. And you assume that they can get there as fast as an order can be placed, which is like 20, 30 seconds. So no, it's not going to execute. Okay, so the price drops to $37.75 at the same time you have executed the order, or the order meets the market. Will this order go? Yes, and at what price? Yes, it's going to be the better price. Some people are tempted to say some people attempt to say $41, but no, that's your upper limit. If it's it's like going to the market over there and saying, okay, I want coffee, and they say, oh, it's only $1.50. Well, here's $2 because that's what the most I can pay. You wouldn't do that. You would pay the best price. Maybe there's some unexpected sale. Okay, now let's do the day limit order. So the difference between the fill or kill and day order is that the day order stays open for the whole day, not just once. So this would be the same example as if that person, you say to this person, I'm saying to you, I want you to get a cup of coffee from me, don't pay more than $2, and I want you to stand there all day and keep asking until you get my price. So you go over and they say, you're like, I'd like to buy a cup of coffee, they say it's $2.05. So then you wait a second, you ask again, okay, I'd like to buy a cup of coffee, and they say it's still $2.05. You stand there all day from 9:30 to 4, asking to buy that cup of coffee for $2 or better, and all day they keep telling you no. And then at the very end of the day, they said, okay, fine, we'll give it to you for $2. You say, done. You will be there all day, and they may not get that cup of coffee from you, but you're going to be asking every second if you can. That's the advent of a day limit order, is you're basically asking the computer to keep checking the price for you all day long in case the price falls into a range that you're willing to purchase. So with that being said, I'm going to give you a second to fill out these same questions on the day limit order, to think about it and fill this out, and then we'll go over it. All right, so let's look at the day order. We're going to ask the same questions. If the stock moves to 42.25, will the order execute? No, because it's higher than the limit of 41. If the stock price moves to $34 3 days later, will it execute? No, it's a day order. So it's going to expire in that day. So 3 days later, it'll be expired. If the stock price drops, see how it can be tricky? These can be tricky questions. If the stock price drops to $38 3 hours later, will this execute? Yes. And at what price? No. It's going to execute more closer to, oh wait. This is sort of a, oh no, you know what? It would be 38. I'm getting confused because I thought it's currently selling at 41, but our limit is 38. So as soon as it touches the limit, it'll trade at that 38.
So 38 or less.
Or less, but it has to touch the 38 first. As soon as it touches the 38, it's going to execute as a limit order, so it's going to buy it at 38. Now, the next set of questions will address what happens if it goes below that. So we'll talk about that next. But yeah, it would get it at 38. See, it's a limit order, so it has to get it at that limit or better. Okay, so if the stock price drops to $37.75 the same time you execute the order, we already know the answer to this. Yes, it'll execute, and at 37, I have no idea why this is red, $37.75. Okay, I've already had you do the good till cancel limit order, so let's look at that. Now, like we said, this is typically good to cancel means 6 months. So it's going to be an open order for a while. So can you imagine if you went to that marketplace and you have to go there every day in 6 months until you get that coffee from me, and you have to go there every day and ask to get a better the limit or better price every second of every day until that's filled. So that's a lot of work. That's what's good about the computers. They do this work for us automatically behind the scenes, so you can be at work and not have to watch your stocks constantly. And if you look at the stock market challenge, there are students who are trading a lot, and they're probably watching their stocks pretty frequently during the day to make 25 cents a dollar per share to lock in the short-term gains. Now, if you know how to set these limit orders, you can let the computer do it for you. So you can buy a stock at 50 and say you want to sell it at 51, and you just good to cancel, and you just wait. As soon as it hits 51, it'll sell. So that way you don't have to watch the stock market. There may only be a 20-minute window where it actually gets to that price. And if you don't get to the stock market to see that, you won't be able to get your price. So these limit orders is sort of like placing these orders for you when you can't be available to monitor the stock market. So they're a good advantage. All right, so the stock price drops. The stock price moves to $42.25 because we're starting out at 41, and we know that this is not going to execute. Now, the stock price moves to $34 3 days later. Will this execute? Yes, because it's good to cancel. So in 3 days later, if the stock price goes below 38, it's going to execute. But the question is, what price? What price will this execute at? No, because as soon as it hits 38, it's going to execute at 38. It doesn't know, it's a computer, it doesn't know, oh wait, it hit 38, but I could read the future, it's going to go down to 34, I'll wait to buy it as soon as it hits 34. It doesn't know to do that. So you may look at the computer and say, oh wow, the stock went to 34, did I get it at 34? No, I got it at 38. I'm kind of disappointed. I would have been better off not having this limit order, and then I could have bought it at 34 instead of 38. But yeah, it's going to buy, as soon as it touches that limit, it's going to buy it. Yes?
So for the day limit order, why
because it's 3 days later. it didn't happen that first day. It happened 3 days later. So the order's already been expired. The day order only lasts for 1 day. So 3 days later means the order's already expired. It can't be placed. But here, this is a good to cancel, so it lasts for 6 months. So in 3 days, the order's still open.
Right, but I'm talking about the last question of the day limit order. If the price drops to 37.75 and it was open all day, so it kept asking.
No, the time. This means the same time you execute the order, the price is better. So it can't buy it for you at 38. It's not available, so it's going to get you the better price. So that happens sometimes. Sometimes at the time you set the order up, and a lot of people try to set the order up at the price it's currently trading at because they don't want to pay more. So you might actually wind up buying it for less. By the time it executes, it's lower than what you set the limit up for. Okay. Good question, by the way. Yeah. So her question was, if the price happens to be lower before the order hits the market, are you going to get it at 38? But no, in this case, you're going to get it at 37.75. That's the same question down here. Same for the good to cancel. If the time your order first hits the market, the stock price is actually lower than your limit, it's definitely going to execute, but you're going to get that lower price. By law, they have to give you the lower price. They aren't going to say, oh, your limit's 38, so we're going to sell it to you for that. They have to give you the better price. So the one last question here is, if the stock price drops to $38 3 hours later, will it execute? Yes, it will, and at 38, just like the previous set of the day order. So that's still going to work out. Okay, so let's move down. We're just going to talk about the last two, which are stop order and stop limit order. Now, a stop order is something you use generally when you have a position already. You own a stock. So limit orders is something you can place actually if you are going to buy the stock for the first time or if you want to sell a stock you already own. You can use a limit order to set a desired sell price as well. And that would just mean you own the stock and you say, I want to sell it at this price or better. So if you own the stock and it's currently at $20, you say, I want to sell it at $25 or better. It'll wait till the stock hits $25 and sells it for you at $25. So you can also use a limit on the sell side. Now the stop order is generally used when you have a position. And what this basically says is you're not actively looking to sell it, but you want some assurances in case the market has a flash crash, which happened a few years ago. And what this stop order is basically says that it's a line in the sand. Say you have 100 shares of Google, and Google's at, 600 and change? I'm not exactly sure. It's a lot of money. Now, you want to say that if Google ever reaches 400, sell it, because you bought it for $100 a share somehow, and you never want to take a loss in this. So if Google ever hits 400, something really bad has happened. You just want out at that point. But if Google still continues to go up or fluctuates a little bit each year between 700 and 500 or whatever, you're fine with owning it, because you know that there's more potential. Maybe it goes to 800, maybe it goes to 1,000. So the order won't do anything unless it actually hits your bottom panic sell number. So if you're someone who has, if it's in a very volatile trading period where the market is at an all-time highs and there could be a sell-off relatively quickly within a week, you may want to protect yourself by saying, okay, I've made 100% gains of all my stock positions. Let me put stop limit orders to protect the gains I had in case there's some sort of crash in the market and the market goes down 20, 30% in a month. So that way I can lock it in, and then I can go back and buy it at a cheaper price later. So you're sort of just trying to protect yourself. Okay, so that's the premise behind the stop order. Now, the regular stop order, when I have the GTC next to it, just means good to cancel. So you don't have to worry about day or limit. The regular stop order converts to a market order, which means that when the stop order is triggered, the price on the stock order is just a trigger. It turns into a market order, and it's going to get you whatever best price is available at the time. So it may not exactly be the same price as the stop order. That's why they came up with the stop limit order. So the stop limit order doesn't turn into a market order. The stop limit order turns into a limit order, and it's going to get you pretty much the exact price of the limit. So you have even more control on the stop limit, but that's going to cost more commission. So you can put a stop just a regular stop order, sometimes called a stop loss order, and that's going to turn to a market order. It's going to have its set of commission. And then if you want a stop limit, it's going to be a little bit more expensive commission. Same thing with the general market and limit order. A market order is generally the cheapest commission-wise to set up. A limit order is generally a little bit more money to set up. Since you're getting an added benefit of the market continually checking to get you your limit price, they're going to expect more commission. So that's why they sort of, not only did they give you these advanced tools, but like everything else, they want you to pay for those extra services. Some brokerage may really have a small or insignificant difference between the cost of these orders, depending on the broker. And the discount brokers have a smaller to no difference usually in these orders, and the full service brokers usually have more cost. Okay, so let's look at this stop order. So the setup is 100 shares at a stop order price of 38. The stock is currently trading at 41. So it means if this stock goes to 42, 45, 50, 60, nothing's going to happen. But if it ever touches 38, it's going to try and sell it to you as a market order. And it's good to cancel, so we don't have to worry about days or hours here. All right, so if the stock price moves to $42.25, will this order execute? No, because it didn't touch the stop position of 38. If stock price drops to $34 in 3 days, will this order execute? Yes, this is going to execute. It's going to turn into a market order, so you're going to get a price around 38. Because 38 is just a trigger. It touches 38. If it stays 38, you'll be able to sell it at 38. But it might be 38.25, 37.75. It just depends, because it takes time, but the trigger turns into a market order. That has to wait in line. By the time it's placed, this could all be within a minute, there could be a slight change in the actual price. And that's the risk you take when you place a stop order, a plain stop order turns into a market order. So we know that if the stock price drops to $38 3 hours later, that this is going to execute, and it's going to be around 38 because it turns into a market order. Now, if we want to get the stop limit order, this is a better order because we have more control of the price we're going to be selling the stock at. So here, again, we're going to have the same, pretty much the same answers. If the price is higher, it's not going to sell. And this is good because if we're on a hot stock and this hot stock keeps moving up and higher, we don't want to sell. We want to hold it as long as it's moving up. We actually, if it moves to say a $60 range from 41 to 60, maybe we cancel our stop order and we reset it at 50. So that way you can kind of trail the stock upward. So as long as that momentum's there, you always stay maybe $10 or $15 behind it. And then if the momentum changes and it starts to go down, now you're going to sell it. It's sort of like you could have done this with oil. In 2008, oil was $50 a barrel, and it went up to, say, $150, and you could have shadowed it the whole way, staying back beyond it enough, maybe $20 a barrel, so daily fluctuations won't sell it on you. And then as soon as it starts to go down, and maybe it stopped, maybe the height was 150 or 140, and you had it at 120, and it hits 120, it sells. Now you can just wait, and now when it's back down to 50 as it is now, you can buy it again, and then set those limit orders up to chase it back up.
Do they charge for order?
Okay, so continuing with the stop limit order, if the stock price drops to $34 in 3 days, will this execute? Yes, we know that, and it's going to be 38 because it's a limit order. So it would have to touch 38 to get to 34. As soon as it touches 38, the stop order turns into a limit order, and you're going to get 38. It's a priority. It has a priority order status, so it's going to be above the market orders. And so same thing, if it's 3 hours later, it is going to execute, and again, you're going to get it at 38 as a limit order. So that's the benefit of the stop limit order, is you know what you're going to be selling it at. It's not a surprise like a market order could be. Okay. So again, I encourage you to use these different types of orders in the stock trading simulation, the market watch game. Use these different orders so you get a good feel of different things you can do, and you can actually set your positions up in the morning, put all these limit orders or stop orders on them, and then see how you do by the end of the day. And this would be the same thing as if you were sitting there day trading all day. Okay, so we're going to do short selling. Now, a round lot means 100 shares of stock. So a lot of times on these handouts, I'm going to be talking about a round lot, which is 100 shares of stock, not one share. So for this handout, we're going to assume a round lot. Each of the following situations, we're going to calculate a profit or loss, excluding commission. We're not going to really worry about commission right now. So selling short is selling something first, then buying it later. It's against your human nature, because what you generally do is you buy something and then maybe you sell it later. So you buy, maybe you buy a video game and then you sell it back later, or you buy a textbook and you sell it to somebody else later. So that's the modality you're used to. The great thing about the stock market and these brokerage accounts is they will let you sell someone else's stock and then you could buy it back later. And this is good for when the stock market is going lower. If the stock market is moving lower, remember, it may take 5 years for the stock market to go up 100%, but it could take only 5 months to lose those same gains. The stock market moves lower much faster than it moves higher. So in an environment where we have a bear market and prices are going down, you can make a lot of money much faster by short selling. Selling first, hoping the stock price will go lower, then buying back at a lower price. It's sort of like, the new Xbox One. It was selling at $400 for an Xbox. They just lowered the price to $349. So if you were selling them, say you had been selling, you sold 10 of them, but you hadn't really purchased them yet to sell them. Now you can go ahead and buy them for $50 less than you would have paid because the price went down. So you lucked out that the price went down before you actually had to purchase them to give them to the people that you already sold them to. Same thing with the gas station. Maybe the gas station, well, no, that'd be a different type of scenario. Forget that example. All right, just go right back to stocks. You sell short at $20 a share, and you repurchased 18. So remember, the first thing you did was you sold something. So when you sell something, you get money. So figure you sold short, which means I sold 100 shares at $20. I'm getting $2,000. Now, when I repurchase, when you purchase something, you spend money. So if you purchase something at 18, I'm spending $1,800 to purchase. And that means if I sold it for $2,000, purchased for $1,800, I made a profit of $200. Now, more typical, what you're used to is maybe somebody else, they could have purchased at 20, means they spent $2,000 to purchase the stock. The stock went down and they sold it at 18, means there's a $200 loss. See how that's a reciprocal of each other? Now, the great thing about the stock market is there's so many shares out there, and all the shares are in the broker's name. So the broker, if you request to sell a stock short, they could lend you somebody else's stock, so you could sell it short. But you sort of create this hole, and you have to purchase that stock back at some point to fill that hole back up. So it's just, the stock market just works in the way that you're able to sell something before you own it. But they have they know that there's a certain amount of equity in your account, so they know that they're going to make sure you fulfill on buying it back later. And there's no time limit. As long as you have the equity to support it, you can have these short positions open for a while. Okay, so let's look at the next example. You sell short at 15, then you repurchase at 18. So that you're selling at 15, but then you're repurchasing 18. Right there is a $3 loss or a $300 loss. It would have been better, of course, to buy at 15, buy long. We call it long position. Buying is called a long position. Selling is called a short position. So long and short are codes for buying and selling. So if we take a long position at 15 and then we sell at 18, we know that is making $300. So again, the last one, we sell short at 25 and repurchase at 18. Yeah, that's a good deal. That's a $700 profit. Much better than if we... We sold it at 25. Okay, so that when we sell something, we made $2,500 by selling it. Repurchasing it, we only spent $1,800 to repurchase. So, but it's easy to get these mixed up. That's why you want to practice trading them in the virtual stock market. Sell some things short and see how you make money or lose money. What you were thinking was in normal terms. You bought it at 25, sold it at 18, and that would be the $700 loss. And that is, it's hard to break that mold. I'm going to give you a second to do the next grouping by yourself. I'll give you a second to calculate that. Okay, so here it's not reciprocals, they're mixed up a bit, but you can see if you sell short at 30 and then you have to buy it back at 43, which means the stock price went up, you lost $1,300. So when you sell short, you always want the stock price to go down. That's how you make a profit, because you could buy it back for less. Now, on the second position here, if you took a long position at 30 and then you sell at 25, you're making a $500 loss. And that's intuitive. You don't want to sell something for less than you purchased it for in the stock market. That's how. Sometimes it's unavoidable. You just have to get out of a stock because things have changed. Maybe you owned Radio Shack, and that would be something you should have sold a while ago. You know, because they just declared bankruptcy and soon their stock isn't going to trade at all. It's trading for pennies. So sometimes when you're involved with a company that doesn't have a bright future, you may have bought it and didn't think enough about it, and then once you think about it, you're like, all right, probably not a good bet. And you selling it, it's better to have a $500 loss than a $1,000 or $1,500 loss. So sometimes selling even at a loss is a good idea. All right, if you sell short at 53 and repurchase, so a better thing to do with Radio Shack would be to sell it short at 53, and then when it reaches 23 to buy it back, and that would be a $3,000 gain. But if you take a long position at 53, you're hoping maybe at one point it goes up to 65, so it'd be a $1,200 profit. And the same thing if you sell short at 48, it goes down to 41, $700 profit. But if you take a long position at 48 and it goes to 47, the long position when the stock price goes down equals a loss. So the second part of this handout, the margin calculations, we're going to do after we cover Chapter 5. So we're going to cover that later.